You're watching Famous Dave on YouTube.
Hello and good morning and welcome back. You're watching the Short Vol Show live, coming to you live from YouTube in Cape Cod, home of the Pilgrims. And the discussion today is GameStop. We just went on StockTwits and riled some people up. There's a lot of angst against people who are short this stock there. I'm not trying to rile people up in any way because you can be short or long. That's up to you. And I don't harbor any resentment towards anybody based on what positioning they want to have in a stock or option. Anyway, I did want to talk, though, for a sec about GameStop and the events of the last few sessions because I had a situation where I was right on the direction, but I didn't really make money, which was frustrating, and I wanted to talk about why. And to do that, we're gonna pull up the Greeks of my position. Now, the Greeks being Greek letters used to represent different ways of quantifying risk in an options position. So we have the delta. Now, delta is probably the most known Greek to most people, and there are three definitions for delta. One is just the stock equivalent. So if it shows 135 short delta here, that means that my position is the equivalent of being short 135 shares. So you can have a bunch of options on, but to kind of translate that into stock at this particular price point, 187.99, I have the equivalent of 135 short shares of stock. Now, the gamma, the second Greek, is going to make this number move around, right? So I have a positive gamma at this spot here. That means that as the stock goes higher, my delta is going to go the same way as the stock, so my delta is going to get longer. So here we have I'm short 135 deltas with 0.85 gamma. That means up $1, my delta will go higher by 0.85. So it would be, instead of 135, it would be 134 something. It's less than a point, so it's not a huge amount of gamma compared with the delta here. The other definition for delta is just how much money you'll make if this goes up $1. So if I am short 135 deltas, that means that up $1, I'll lose 135 dollars. Down $1, I will gain $135. So stock equivalent. And the third definition for delta is the hedge ratio. So for example, if we're looking at an option here, for example, the stock's 187. So if we were looking at, say, the 187 call, this is an at-the-money call, and thus the hedge ratio for this would be about a 50 delta. So for each 2 options you buy, you would sell 100 shares of stock. Since this is right at the price of the stock, then there's sort of a 50-50 chance that this will finish in the money, right? So that's why if you were to hedge this with stock, you would sell 50 shares against this. Each option in standard terms controls 100 shares of stock. So if you have an option that controls 100 shares of stock and there's a 50-50 chance that the option will finish in the money, then you would hedge that with 50 shares of stock. So that's the third definition of delta, is the hedge ratio. In this case, if it was an at-the-money option, it would be 50 deltas. But the pertinent Greek to the situation we have right now, where I was short deltas, stock went down, and I didn't make money, the reason for that was this Greek here, the Vega. Now, Vega represents, has to do with the volatility of an option. And volatility can be defined in this context as the price level of options. And we can compare options in one stock or underlying to options in another stock or underlying by using a volatility number. And if you look at the screen here, it shows options. On the right here, it's going to show, and it's going to give a rough average volatility number for each month that these options expire, or each expiry has on this chart has a number associated, a volatility number associated with it. And so Vega could be defined as the number of dollars that you will make for a 1 point move in volatility. So if we're in December here, my position is all in December, and we see this number at 89.87. So if this number were to go up a point and I'm long 60 Vega, then I would make $60 if this number were to go from 89 to 90. But what actually happened was that as the stock went down, the volatility of the options actually came in or went down as well. And so last time I looked at this was around 95. And with the stock down a few points, all of a sudden this number went down to 89. Now, there are a number of reasons for volatility to go down. It's not just that the stock went lower. We have noticed with these meme stocks, however, that as the stocks kind of move down, the volatility comes in. Now, that's not normal. A normal stock volatility would go down as the stock moves slowly higher, right? That's what normally happens. And volatility would actually increase if the stock went lower. And that is due to the fact that most stocks slowly rise. So if you've got a stock all of a sudden that's bucking the trend and not slowly rising anymore, but that is all of a sudden going lower, that usually is cause for concern, and you'll see volatility start to pop as the stock moves lower. With these meme stocks, however, the higher they seem to go becomes cause for concern, and volatility seems to expand as they move higher. I think that is just another thing that speaks to the fact that that these higher and higher moves are not something that is generally thought of as a quote unquote good thing by options traders, and that's why as these move higher and higher, you see volatility start to expand, and as they kind of come back into orbit and move down a little bit, volatility contracts. But regardless of the why, the actual facts of the matter are this stock moved lower, or when this stock moved lower a couple days ago, volatility did come in. It came down, and these December options, the farther out in time you go, the more sensitive options are to volatility. So these December options with 80 days to go are more sensitive to a 1 point move in volatility than, say, the October options. And the ones that are even farther out, like let's say January 23 or 24, are even more sensitive to volatility. And you could actually check on these option screens. We can go to this middle column here, and we can look at Vega per option. For example, here I just switched the screen to so that I believe this. Yes, this closest row to the actual option bid here that I'm kind of pointing to with my pointer is going to tell Vega per option. And so if we were to look at, let's say, the December 200 call, we would see it has 0.35 Vega per option. And if we were to go out farther to, let's say, Jan 23, and we were to look at the 200 call out there, you would see that, well, that call has twice as much Vega. So it's more sensitive to changes in volatility the farther out we go. And if you think of it in terms of probabilities, the farther out in time we go, the less certainty we can have of where the stock's going to be, right? The more time that we have available for stuff to move around, the more likely it is that something's going to happen. Sort of put another way, if a stock's trading 50 and you have a week before expiration, what's the likelihood that the stock's going to go to 20? Well, it's more likely if you have 10 years than if you have 1 week that a stock is going to make some strange move, just because you have more time for stuff to happen. And thus, as we move out in time, options are more sensitive to volatility. And so what is the answer to all this? Well, the answer to me is I should have been aware of that phenomenon. And what I could have done is I could have sold something against these put spreads that I'm long. I was considering before selling this 110-100 put spread. And indeed, this, I believe currently the midpoint is like $1.20, but this was trading around 130, this 110-100 put spread, with the stock 195. And when stock got down to 185 a couple of days ago, this was trading 93 cents. So if I had sold some of these downside spreads, it doesn't make a whole lot of sense, right? It's like I'm exposing myself to risk to the downside here, but knowing that volatility goes down as the stock moves lower, indeed, this spread, which is has a positive delta associated with it, actually it decreased in value as the stock moved lower, because the forces of volatility in this case are stronger than the forces of delta in this particular trade, due to the fact that it's a way out of the money put spread in a month that is a little bit farther out in time, 80 days till expiration. So if I could do it all over again, I'd do a lot of things differently, of course. But one of the things I would do differently is maybe I would sell a few of these spreads against my position. That way, kind of offsetting this long Vega position that I have. Now, you can see right now it's showing me long 50 Vega. Now that we're down to 89, well, maybe I just leave it, because maybe it pops back up again. Now, we're noticing as this drifts lower that volatility comes in. However, if it were to like gap lower, then they would probably just raise everything up in prices, because that would be a shock to the system. So if this were to go down like $100 today, then volatility would likely spike higher. But a slow drift lower seems to have the effect of just of volatility coming in a little bit. So we've seen that, and we'll continue to monitor that moving forward. It looks like, so currently I'm showing short 127 deltas with the stock indicating to be opening down $1 and change. We'll see if that continues. The futures are off a little bit today. E-minis down 32 right now. I think they were down a little bit more earlier. Let's take a look at that chart. You can see an expanded chart here. You can see the sell-off we had last week, then the rally back. That was the Evergrande China situation. And then we can see sort of a new sell-off starting here today. And but let's zoom in here on what happened overnight, and we can see, yeah, we were down a little bit further. We're down another 10 points around 6:15 this morning. We've come off the lows a little bit. And NASDAQ also down 1.3% currently, with E-minis only down 0.77%. So NASDAQ's getting hit harder than the E-minis right now. We're seeing the VIX firm up. VIX now 2082. If you look at it compared with last week, we don't have the spike that we had last week, but we could be on the way there. You can see last week we had this kind of like ramp up and then boom, gap spike up here. We're seeing a similar pop here. We'll see if that continues. If we look at UVXY, we see it strengthening as well. And once again, we'll see if this kind of just fades away on the open or if this downtrend continues. We haven't even opened yet today, so to kind of characterize the whole day would be, I think, kind of getting ahead of our skis a little bit here. But So far, the market indicated lower on the open. We'll see what happens. We've got about 20 minutes till we actually do open. I hope you have a fabulous day and that you make $1 zillion, whether you are long or short. Good morning, Tom. What's going on? Nice to see you here. Bright-eyed and bushy-tailed for another trading day. Thanks, everybody, for watching me. Please support me on Patreon. Thank you for those of you who are members on YouTube. I appreciate your support. I'll talk to you soon. Bye.